My name is Aaron Malton. I'm an investment specialist at Prudential Investment Managers. And joining me virtually today is Gautam Samarth from M&G Investments in London. He's a fund manager at M&G and co-portfolio manager of the Prudential Global Equity Fund. Maybe we should take a step back and examine what artificial intelligence is, what machine learning is, and are they the same or are they different?
Okay, great. I think that's a great place to start actually, because machine learning is showing up everywhere, from self-driving cars to voice assistants. It's becoming a day-to-day part of our everyday lives. But when you ask someone to actually articulate what it is they mean by machine learning or what techniques they're actually talking about, people oftentimes struggle. So if we start with the history then, and the concept of artificial intelligence dates back a lot further, but the term was actually coined in 1955 by a group of scientists led by John McCarthy. So he, along with Marvin Minsky, Nate Rochester, and Claude Shannon, got together in 1955 in Massachusetts, and they wrote a seminal research paper where they hypothesized that every aspect of learning could be so precisely described that machines might be able to simulate it. Things like language, problem solving, learning from their own mistakes. That really was a seminal moment for AI. And a lot of the predictions or concepts that they talked about in that paper have come to pass today. So we use things like NLP, natural language processing, for language. We've come across machine vision for sensing. But what are the techniques that have been used in order to achieve these outcomes? But all the techniques have fallen under one of two different categories. It's either been classical programming or machine learning. So let's explore those two concepts. It all really started with classical programming, and it goes something like this. If you assume that you know all the rules that define a particular system, then all you have to do is gather data, apply the rules to that data, and come up with a set of predictions or answers within that system. So you start with data and rules, and the output is a prediction or set of answers. Machine learning is very, very different. Machine learning starts with the assumption that you don't know the rules that define a particular system. So then what you have to do is start with data and answers. And once you have data and answers, then you can employ very clever algorithms that learn the rules that connect said data to answers. So over here, the input is data and answers, and the output is rules. And once those rules are learned, then you can apply them in a much more classical fashion. So you take in fresh data, you apply the learned rules to that fresh data, and out comes a set of predictions and answers. I think what's important over here is also understanding the most valuable piece of these different approaches. So clearly in classical programming, the expert was very valuable because the expert was the one who told you the rules, and therefore you could code them in. When you move into machine learning, the most valuable piece is the data. The more data you have, the better the labels on those data, the better the rules are going to be and the better the predictions are going to be.
So now if we turn to investments and the Prudential Global Equity Fund, the question then comes up, why did M&G decide to deploy machine learning in investment management?
At the product level, we differentiate between beta component, so the component of returns that we associate with beta, and stock picking alpha. And that beta goes beyond market beta that you would associate with passives or tracker funds to include beta to alternative risk factors like the value factor, momentum, growth, etc. Our belief is that as these beta components get more and more commoditized, it really raises the bar for what a truly active stock picking fund needs to return. So it's not enough if you run a growth fund today to say that you're beating the broad market index. The burden of proof is, can that active growth fund beat some passive implementation of growth? Now, how we do this, or the approach that we've taken, is to leverage machine learning in order to replicate, but also enhance some of the complex decision-making process that an active fund manager would use. So we're trying to access that piece on the red bars on the right-hand side, the idiosyncratic piece, by replicating active fund management using machine learning, but then also enhancing it. Pretty much in the way that machines learned from grandmasters in chess, but then got better. Increasingly, industry expertise and experience is just going to be not enough in terms of delivering on your investment objectives. And the reason for that is, if you even take our benchmark, which is the MSCI All Country World, it's got about 3,200 stocks. But when you broaden that investment universe out to all companies that are in the investment universe in the All Country World, that increases to, as you can see on this slide, about 8,500 companies. Now, I don't care how big a research platform you have and how hardworking your research analysts are, there's absolutely no way that you can just cover this entire universe. And so then fund managers have to make some decisions as to how to narrow that investment universe into something that's more manageable. I can talk to my experience when I was running an active fund. We had a watch list of securities that was about 300 companies. And we employed similar sort of screening processes to narrow down the universe to 300 companies, but we were always scared of what we call the error of omission. And what I mean by that is the likelihood that companies that absolutely aligned with our investment beliefs and would have generated very positive returns for the portfolio, but we just absolutely missed out on them because, our process was quite crude in narrowing down that universe. Contrast that to the machine learning algorithm that sits within the PGF equity fund. It looks at all the metrics that a normal financial analyst would look at. So it's looking at over 250 metrics for all 8,500 companies in the universe. And then it's creating a rank order preference of all those companies in your universe. That's such a lucrative place to start looking. And you can still employ your research analyst team, but you can employ them at the back end now. You can say that these are the stocks that the machine learning algorithm have identified as potential outperformers. Can you check them for some false positives where the data might not be right? The reality is all machine learning models will make mistakes because all machine learning models are biased. How you get around this is you need a level of human intervention. The question is, what level of human intervention do you need? Why should M&G be able to compete in this space where there's tons of resources? So what's our edge? And this is really where I believe that our fundamental backgrounds, both Mark and I, as I've spoken about, come from managing fundamental equity portfolios. That really helps us focus the data science in order to eliminate some of the noise that's prevalent in financial markets. I'd argue that the key element to move from the data stage to the information stage is having the right context. Once that data is in the correct form, and you can call it and transformed into useful information, in order to drive insights, you need capable models. And this is where the data science piece comes to the fore. And then obviously, once you have insights, in this case, a series of buy or sell recommendations, how do you make a decision as to which stocks do you put into the portfolio? That's inherently a process of having trade-offs, complex trade-offs, and you need to have an investment process that is systematic and repeatable in order to go from insights to decisions.
So the Prudential Global Equity Fund investment process then effectively combines machine intelligence with human intelligence. But the question then is, how successful has this process actually been in delivering performance?
We've been running this strategy as a carve-out within the PGF equity fund for a little over 2 years, coming up in 2.5 years now. And the results look promising. We've outperformed the benchmark within this carve-out strategy by over 20%, close to 10% annualized. And we're very careful about sample sizes, and we're very aware that this is really still a short sample size, even though it's over 2 years. But we're monitoring other things at the portfolio level, the times in which it's working, how often are these things working, that give us confidence that the things that we're doing and monitoring are all pointing in the right direction. So we're very, very excited.